Me and a very good morning to all of you friends. It's a pleasure being here, and I met a lot of familiar faces, so feels really good to be here. So I have a very simple message for you, and what I have often shared for last right throughout my career, that India is a growth economy. It continues to do extremely well, and that equities are a asset class that reward patience. So as some of you might recall what Mr. Buffett has said, that equities are an asset class that transfer wealth from the impatient to the patient. And those of you who have been patient with equities, irrespective of what funds you bought, irrespective of what format you bought, I am sure it has created wealth for all of you and for all your customers as well. So let me share with you some thoughts as to what is the view going forward. So I think this is a time to reset return expectations. And you would recall when we used to meet 10, 15, 20, 30 years back, all of us used to discuss that how Sensex Nifty should compound north of 15%, between 15 and 20% a year. I think something has changed, and that is what I want to start off with. Why for the future those returns expectations are less likely, unlikely to be met, and why returns should be lower. So this chart at the top, any business grows in two ways. One is the real growth, volume growth, and the second is inflation. And if you add the two together, it gives you the nominal growth of that business. Economy works exactly the same way. So economy has real growth, which is often published in the papers, and currently economy is growing around 7%. That's the volume growth, the real growth. So the blue bars here, they give you data from 1980 to 2000, and the orange ones give you data post 2000. The first two columns give you the real growth of India, and you will see the real growth has been by and large same, around 5 to 6%. Going forward, we expect it to grow slightly higher, maybe around 7%. And then move to the third set of columns, that is the GDP deflator, which is a better measure of inflation. So you will see here that inflation in India post 2000 has been significantly lower. And what has happened, as we have opened up the economy, supply side, all reforms, what do reforms do? They increase competitiveness, competition in the industry, in the economy, improve the supply side. And because of that, you will have seen the price rise has come down. So inflation has structurally moved lower. And if you add the real growth and the inflation, the GDP deflator, you get what is called the rupee growth of the economy, or the nominal growth. And you will see in the fourth set of columns how the rupee growth, the nominal growth, has actually been lower post 2000. That is because of the sharply lower inflation. And now if you go to the extreme right, which is the returns of Nifty over these periods, you will see how returns of Nifty post 2000 have also moved lower in sync with the lower rupee growth of the economy. So I think we need to readjust our expectations to a lower inflation world. We feel happy to borrow home loans at 8.5%, but that also means your bank deposit rates are lower, and that also means your rupee growth is lower, and that also means your future returns of Sensex Nifty should be lower. So I think the most important, I'm sure many of you realize this, but India is now a lower inflation country. RBI targets inflation around 4%. So if you add 7% real growth and 4% inflation, it takes you to 11-12%. So I think there is a need to reset our longer term expectations from Sensex Nifty around 11-12%. I think the good news in India is that our real growth is likely to accelerate. You saw we grew between 5 to 6%. I think going forward we could grow 7% or slightly even higher than that. And why should we grow faster? I think there are 2 or 3 key reasons, and let me briefly take you through these. Manufacturing is finally coming to India, and manufacturing is coming to India for 2 reasons. One, our costs are now lower. The top chart, it tells you the per capita income of 5 Asian countries in 2000 and in 2023, and you will see India's wages, India's per capita income is quite comparative. So it makes economic sense to move manufacturing to India, and we see steadily a large number of multinationals that are coming to India to set up shop. And the second reason is geopolitics. Companies want to diversify their supply chain away from China, from the over dependence, and these are two reasons why manufacturing is coming to India. And whichever country gets global manufacturing, GDP growths naturally move up. The second reason for faster growth is that post-COVID, as remote working has gained acceptance, global companies are setting up global capability centers, GCCs. Basically, functions like accounts, taxation, legal, HR, payroll, detailed engineering, you can do these remotely. So India offices are being set up by these multinationals, and they shift lot of jobs. And you can see in the charts on the middle right hand side how the GCC exports or business service exports have grown exponentially. So JP Morgan, for example, has 50,000 people in India. Almost most of the companies have, and that headcount continues to increase. So our service exports are growing rapidly. This is also a reason why your current account deficit has structurally moved lower, and because of that also your rupee depreciation and inflation should be lower, which again leads back to low inflation and lower returns. The third reason, which is quite talked about by all funds, is that capex is reviving. India is coming out of a 10-year down cycle of capex. Bank NPAs have peaked. You would recall how banking NPAs hit the corporate banks. We have moved beyond that phase. Corporate leverage is extremely low. Corporate profitability is good. So capex, which is somewhat cyclical, is reviving strongly, and that is the third factor what should drive growth in India. So these are three reasons why we think India's real growth should be 7% or maybe even slightly higher. I think in the last 10-20 years we have improved business conditions a lot. Our physical infrastructure we don't complain about, or we complain a lot less. Digital infrastructure is fantastic, and we don't have any serious regulatory challenges. Go back 10 years, 20 years, telecom challenges in ports, airports, power, telecom. There were so many coal mining. There were so many regulatory challenges. I think our regulatory framework has improved. We have carried out a lot of important reforms like IBC, GST is stabilized. So by and large, the business environment in the country is a lot better now. India's macro fundamentals are very strong. So this chart tells you how inflation has come down with every passing decade. And that again we go back to the same point. Lower inflation means lower growth in rupee terms, lower returns. The gap between Indian and US 10-year yields is at an all-time low. So I have spent all my career observing India minus US 10-year between 4 to 6%, and now it's running between 2 to 2.5%. So cost of capital in India has moved lower. Currency depreciation should be lower going forward as we are in a lower inflation world. We discussed that rising service exports through GCCs, and you can see the effect of that in the fall in CAD, current account deficit, which is basically the gap between exports and imports. And lower CAD has led to a situation where FDI is sufficient to meet our CAD. So FDI is foreign direct investment. There are two ways capital comes to India. One is if you set up a business or if you buy shares. So portfolio flows, the FII flows which we track so closely are quite volatile. But the FDI flows, what global companies are bringing capital to set up businesses in India, they are very stable. So India is now in a very strong situation that the FDI inflows into the country are enough to cover our current account deficit. So I think this will reduce the need for India to borrow in dollar terms or to even get FPI flows. We don't need FPI flows to balance our external account. So this is a very strong positive for India. Fiscal deficit continues to move lower, and this government has shown remarkable commitment to lower fiscal deficits. So I think net India's macro fundamentals parameters are quite strong. Coming to equities, these are fairly valued markets. We are all aware of the PE multiples. I think multiples are slightly higher compared to the past averages, but we can justify slightly higher multiples. And there are three reasons for that. One, our growth rates are moving up from 5-6% to 6 or 7 odd percent. Two, cost of capital in India has moved lower. As your cost of capital moves lower, naturally PE multiples move up. And third, I think where all of you have contributed and done a commendable job is today the local flow of savings towards equities is so large that markets volatility has gone structurally lower, and you can see that in the chart on Nifty 50 volatility. But for the COVID spike, volatility is moving lower. So I think this is a great time because lower volatility will encourage households to even further increase the allocation towards equities. So I think currently about 10% of household gross financial savings are coming to equities. I think over 10 years or so, they should move up to maybe 20-30% also. So now when foreigners sell, markets don't tank. Earlier I used to say the best opportunities to invest are when foreigners are selling. But today we have seen that even when they sell, markets simply don't fall. So I think lower volatility, which lowers the cost of equity capital, lower cost of debt and faster growth are three reasons why we are comfortable with the current multiples. And finally, a very important point, I think corporate profits, if you see in the chart below, they have recovered completely, profits to GDP. So on this base, I think corporate profits should grow around 12-14% a year, not more. So this again takes us back that the right expectations from equities in India over 3, 5, 10-year periods. 1 year, no one knows. I mean, that's the nature of asset class. You know that extremely well. So I think if you take a 3, 5, 10-year view, it's definitely a time to temper your return expectations while we continue to be very optimistic about this country, about equities as an asset class. I think let me just spend 1 or 2 more minutes. There is a thought when I meet people, they are extrapolating the last 4-year, 5-year returns, which was mainly because of a low base. And when you explain it to them, they say, look, there is so much money coming to equities that equities should continue to deliver higher returns. I think what that argument misses is that yes, a lot of money is coming to equities, but so is the supply. Look at the IPO pipeline, look at the IPOs getting subscribed every day. So the top chart gives you both the DIF flows, the orange line, and the blue line is the supply of new stock. So you will see that no doubt demand or flow of capital has increased, but so has the supply of stock. So I don't think because money is coming in, we can expect higher returns going forward. I think I would like to, this is my last slide. There are certain pockets of excesses in this market, and small mid caps have done extremely well. I think that space appears to be overvalued to my mind, and the large caps would probably offer better risk reward. And the last point I wish to make is that the second portion where we are seeing excess is in the manufacturing and defense space. So go back 30 years, whichever space attracted maximum popularity, whether it was tech in 90s or infra in 2007-8, they tend to get overvalued. So I am not saying this is comparable to those kind of excesses, they were probably a lot bigger, but definitely I think the manufacturing defense companies which have delivered very high returns and are extremely popular, and you can see the returns and how multiples have changed. I think there is certainly room or logic to be cautious in these two spaces, small mid caps on one hand and the manufacturing and defense space on the other. I think we should continue to remain invested in large caps, multi-cap funds, monitor our exposure to small mid caps through thematic funds, and reset our longer term return expectations. So let me stop here, and it's been a pleasure being here, and wish you all the best and enjoy the rest of the day. Thank you.